Hello, everybody. Welcome to Friday and another Talk Money with Tom show. Thank you for coming today. Looking forward to answering your questions. Pretty straightforward concept here. We're trying to help everybody with their retirement planning, and really that includes kind of financial planning, the tax planning, and the money management aspects. We believe that you can have a more successful retirement the more you know about those three areas. And so that's what this show's about. You can email questions in to ask Tom at talkmoneywithtom.com. Eason, who's here with me also, one of our other advisors, will be getting those questions. You can also now put this into chat. We have a chat window there. You can sign into your YouTube account and put in any questions. And so he'll be moderating that, asking those questions, and then filling in some of the other things from his perspective also as far as that goes. So again, if you want to subscribe to the channel to get these ongoing content that we put there to help you, increase your possibility of a successful retirement, you hit the subscribe button. You can send us your email address through the Ask Tom address there, and we'll put you on our email list if you want to get that information, or you can set an appointment. If you have something specific that you want to talk about, you can go on our website and hit the book an appointment link. And so those are the parameters. That's how we do this. It's really a fun show altogether. I've been enjoying this tremendously. We've been getting a lot of great questions. We already had some questions. You can send them in at any time. Send them in during the show. Send them in during the week and such too. So we'll try to fill that in, and hopefully you'll find something that's useful as far as that goes. I do always like to start off the show with a summary for what I saw in the market this week that I think is important. So obviously the big story this week, really at the beginning of the week especially, was about the debt ceiling. So, the US government is required to basically go and ask Congress to increase the debt ceiling so they can continue to pay the bills. It's become a little bit of a political football, and it's a really big deal for all of the things that might happen in politics that affect the stock market. Really, the debt ceiling to me is probably the number one piece. So when they're starting to, get close to the edge of not being able to pay their bills because they haven't raised the debt ceiling, that's a time to get pretty cautious. And we did over the last 3 weeks. We've been pulling money out of the stock market and just kind of parking it and waiting to see what would happen. The projections are that the market could drop 30 to 40% if they didn't, raise the debt ceiling and we did default. And so that's not something we really want to be involved in. But come Wednesday, finally, there was a resolution that started and eventually was approved on Thursday to allow for a short-term increase in the debt ceiling to get us through to the beginning of December. So again, this is still something we're going to be dealing with. That's not that far away, but hopefully there's enough time in there for things to get organized and some more negotiations to happen so that they can raise it really probably past the midterms, like December of 2022 would be the ideal situation. So that's what's happening right now in that area. Because they did this resolution, we moved back in to the market on Thursday with the assets that we pulled out. That worked out great. For the most part, the market was down lower when we got back in than when we got out. So I like that portion. I don't normally do that, but it is one of these things that is very important to pay attention to and make sure that that works out right. Today, we had a very interesting report that came out, and it had to do with the number of jobs that were created for last month, for the month of September. So the expectation was that we'd have 500,000 new jobs created. Well, it was only 194,000 new jobs. And so that's 2 months in a row that we've had low job growth. The month before that was 235,000 new jobs. And so this is a very fascinating and very, very different scenario. Usually, when we are looking at lower jobs opened than expected, it's because the economy is starting to erode and fall apart. And so that's what we're looking at. This is not what's happening here. The economy actually, on a demand side, in terms of sales and revenue, is growing quite rapidly, but people aren't taking the jobs. There's 11 million roughly open jobs, which is the most in history, and roughly 8 million people are unemployed. And so that theoretically that should match up, and we should have probably 1 million jobs created every month, but they're not taking the jobs. And so at one point the thought was, well, they're not taking the jobs because of the extra unemployment insurance. Well, that ended. They're still not taking the jobs. And then there was another thought that maybe they're not taking the jobs because of school. So somebody has to stay home until school starts. Well, school started, still not taking the jobs. And so it leaves a couple of different areas, which are very fascinating. Number one is via survey, the number one reason that people aren't taking jobs is because their fear of catching the virus, which is somewhat legitimate. Obviously, we had a spike coming up with the Delta variant, and a lot of the jobs that are open are jobs that were closed because of the exposure to the virus. So that's something we'll have to see how that plays out. The Delta variant is trending downward now, so maybe that improves as that gets better and people get more confident and start taking those jobs. But the other area is really interesting. I'm reading more and more articles about how there's some potential systemic changes that are happening in the labor market. So essentially what happens when schools closed, all of a sudden one parent started staying home and the households have restructured around that. Some of them even moved to cheaper places. And there's a thought process there that that might continue. Maybe there will just be one wage earner in a lot of these homes going forward, and one will stay home and take care of the kids after school and what have you too. So that's kind of fascinating to see what happens there. Then you've seen a whole lot of early retirement. So somebody who's going to retire in a year or 2 years or 3 years, they're retiring now. And so that's kind of pulling back in terms of the jobs. And then the other thing is just kind of people going after alternative types of employment. So instead of working at Starbucks, they're getting on YouTube and opening up YouTube channels or doing things on Fiverr or all these different, what we call kind of a gig economy jobs, and really starting their own businesses instead of trying to rely upon these other businesses. So very, very fascinating. But here's what that means to companies and ultimately to the stock market. If you have a company that relies upon people to generate your revenue, which most do, and your revenues are going up, so people are coming in more and more, but you can't hire new people, you can't sell those revenues. So in other words, if you had an order for 1,000, widgets and you can't hire enough people and you can only sell 100, that's going to reduce your revenues, especially what you could have made. So for example, if I have a restaurant, a fast food restaurant, and I can't get new employees, I might only be able to open up my drive-through window and not obviously the people that are, inside. The other portion that's kind of slowing things down has to do with the supply chains. And we've talked about this, but I have a friend in Southern California, sells trucks and cars, at dealership, very successful dealership, usually has 600 to 700 cars. Right now, they only have 5 cars on the lot because they can't get semiconductors to build these cars. So this is a very fascinating thing. This is not a normal scenario. Usually when we see reducing revenues or revenues coming in under expectation is because there is a demand that's dropping off. Well, the demand is still there. It's still coming in, but we can't get the supply. We can't get the people into the restaurants, for example. We can't get the cars into the lot to sell them. And so that's one of the very fascinating things to watch and see how that plays out as far as that goes. Now, those are the things that are going to be kind of weighing on the market here because what we've got is a scenario where the expectations for growth in the third and fourth quarter were really high, and rightfully so. Things are reopening, going really well. But if we can't deliver the products to sell, we're going to have some adjustments. And so a lot of these earnings calls that are coming out now, they're talking about not being able to get enough supply to do this or that. And they're going to, come in with some smaller numbers than were expected. And so the market is going to adjust for that. And that's what we've been seeing altogether. The market looks forward and it says, okay, they're not going to be making as much as we thought. Now, they're still phenomenal earnings. So they're just not going to be as great as expected. And so that has to be an adjustment in the market. But here's my key takeaway, and the thing that I find very fascinating. In the light of all of these things, the debt ceiling, the supply chain issue, the shortage of labor, the Federal Reserve moves that they're doing to kind of tighten things up, China's situation with the big property companies having trouble, et cetera, et cetera, et cetera. The market from a high at the beginning of September to a low as of Wednesday this week, it dropped a total intraday total of, by my calculation, about 5.9% on the S&P 500. That's nothing. Honestly, that type of action happens all the time. In the past, in my experience, when you have that kind of news coming out, and especially a debt ceiling, that's getting closer and closer to the edge, you'd be looking at 10, 15, maybe even 20% downturn. So this is one of my points this year that I think is very important. If you watch the price of the market, you get a lot of information about what's happening, and the market is really, really strong. And that overcomes a lot of these other negative pieces. So if you look, certainly the market is up tremendously so far this year. The positives overcome the negative. Yet the negative is what's out there the most. It's what everybody's talking about. The market's still up. And so even though the market came down here in September and a little bit in October, we're still up over June and what have you. I mean, the market is up. And the power of the market is one of the things to focus on. And that could change, right? Things can change. The market could erode and what have you. But again, it didn't fall that much in the face of all of this bad news. That's something to think about because I think that shows very heavy strength and possibly, some more motion to the upside before everything's over here. So I still think that zero interest rates, are driving money into the market because again, where else are you going to put the market? We're starting to see that really become one of the places where money is going, and that's what we really want. So anyway, that's the summary for the week. I actually think this week was very positive in the end, especially with this debt ceiling, behind us at least temporarily. And I really look forward to see what might happen next week. All right. Let's start with some of the questions. I know we got some this week, and maybe we'll get some during the show too. So why don't we go ahead and fire away, Ethan?
So the first question is, should we still be worried about the debt ceiling because the short-term bill only lasts till early December, and so we saw what kind of market damage just the brink of the debt ceiling could cause. Should we be preparing again for this?
Yeah, that's actually a really good question. And think about it for a minute. We did get kind of close. The actual debt ceiling expired, at the beginning of August, and so they use these extraordinary measures to keep paying the bills. And those extraordinary measures were going to run out, next week, and we just solved it, yesterday. Uh, Pretty crazy. Really, I hate this scenario. I hate that the politicians are playing with this because it's a really potentially damaging. And so, but here's a couple things. I do see some super big positives in the fact that they did do something. I wasn't sure that there weren't. As a matter of fact, there are people in Congress, in the Senate right now, who have advocated for letting the country default. I think that's nuts, but so that scares me. But in the end, they did get it done. They did move the needle to December. So theoretically, to me, that means there's the potential for some more negotiation, that some more softness in that negotiation. Unfortunately, it was an awful lot of criticism about the negotiation, about folding or what have you. Folding on the national debt is not something that's happening. So I do wonder if when we get back to the next level in December, if there isn't more of a hardened base because they got criticized for the positive negotiations that just happened this week. So that worries me a little bit. But the other part is there are some other alternatives that just needed more time. So in other words, the Democrats can get the debt ceiling raised, and again, trying to raise it all the way to next December instead of this December. They could raise it through the reconciliation bill, and now that they have a little bit more time, they're still negotiating on that bill, and so hopefully they can get that organized and in the period of time we have, and then include the debt ceiling increase in that reconciliation bill, and then the Democrats could basically control that and take care of it themselves. So that we'll see, right? Because it is something to still be concerned about, but I am more optimistic about it now. More time helps, and the fact that there was some negotiation that was done, I think, is a good sign. But don't I won't take my eyes off that ball because I think it's a really important component, and we got to make sure that it does happen. But I think what did happen this week is definitely positive.
So another question, Wayne, back to that. What are some top reasons that you're concerned or excited for the market right now?
Oh, okay. Well, top reasons I'm concerned, uh, the supply of people, the shortage of labor. Even though we have a lot of unemployed people, plenty, they're not coming out to work. So we basically have a shortage of labor. And so that creates a couple problems. First of all, companies can't produce as much, and so they're going to start to miss on earnings and revenues. And then also, companies are going to have to pay more to get what labor they can to come out, or to steal somebody else's labor that is willing to work and paying more. And so those teams tend to be inflationary. Labor tends to be the most inflationary piece because almost every company needs labor to operate. And then once you kind of increase pay, it often is doesn't go away. It doesn't go back down. It has happened in the past, but not very often. So that's that. I would say labor is a concern, and then of course the supply chain would be another concern. I think just you got to have semiconductor chips. Ford needs semiconductor chips to make F-150s. So and unfortunately for car manufacturers, the semiconductor chips that they make are lower cost, which means lower profit. And the companies that are making chips are making the other chips that are higher costs and higher profit. And so, this might take a little while to work its way out. I think both the labor and the supply chain issues work their way out, but they have been a little bit more persistent than thought. And even the Federal Reserve has mentioned that they think that the supply chain issue is more of a persistent problem than they thought. So we'll see how that plays out. The Federal Reserve cutting back on bond purchases and ultimately starting to raise rates, it will not cause like a massive downturn, in my opinion. It'll cause volatility. It'll cause, if we were going to make 15% and they started to do that, we might make 8, or 10 or something, so it creates a sort of like a headwind for the markets as far as that goes. So those are kind of the three or bigger thing. Now, what's positive? Look back, go back to 1955, look at the federal fund rate, and look at how many big downturns happened during periods of time when the interest rates were very low or zero. And that was none. And the big downturns have come after lots of upturns. So, for example, the last big downturn that happened in 2008 happened after, 21 rate increases. We haven't even had one. So that's a huge positive. It is the number one thing. It'll overcome all of those supply issues. It'll at least keep the market going sideways, if not up. And so I think that's really, really important. And it really, I can't emphasize that enough. I'll give you some other reasons that I have that I like, but that's the number one piece. It always has been. I think it's a very strong thing to watch very closely. But the other things I think that are very incredible are, just how much demand there is in total as people come back. There's all of this pent up demand, and whether it's for housing, which is doing quite well altogether, or for travel, which is starting to pick back up. And we're still scratching the surface. There's a lot of people still sitting around waiting for the virus to get better or what have you too. And as that starts to get better and better and better, I think that's great. And again, I guess another positive I'd look at the charts by county, by state, nationally. And for the most part, what we've seen is a really big turnover on the virus case counts. They've come down and have started to come down quite nicely, actually. And so that if that comes down and is able to stay down for a period of time, that could be quite explosive on the demand side. So, those are the things I see as quite positive. And good companies will find a way to get the people and the supplies. You watch, and so the cream's going to rise to the top here, in my opinion. You'll see a really, really good scenario probably coming out of this. I think that the positives outweigh the negatives at this point in time. The debt ceiling is such a huge issue that when it comes in on the negative side of the scale, whoosh, it just runs, it runs it down. And so that's why that's important. That's why we made some defensive moves there. But at the moment, that's taken off the table. So I won't put that as one of my main concerns right now. Maybe we'll see what happens later.
So this week we got back into the market and we got back into kind of broad exchange traded funds. Why do some of these funds, even though they have the same investment strategy, kind of different returns, like the Vanguard's total market versus the iShares?
Yeah. So a couple things here. First of all, um, we have these targeted indexes, and we'll usually go into targeted areas, utilities, or something along those lines. What we decided to do this time is to move back those targeted pieces into the broad market, and here's why. I mean, one of the things I do during these downturns is I look very closely at what's happening. So, what happens on a down day? What holds up? What happens on an up day? What goes up the most? And for example, last year, it was the same thing. So it was very obvious. These are the things we want to buy. And so like Apple, went down less on the and up more on the update. So we bought Apple, right? March 5th. And what we're seeing this time, if you look, it's just such a hodgepodge. There was absolutely no pattern that I could see whatsoever. But I do believe in the market as a whole, and the overall market has been doing fantastic. What's been happening though is the money's moving around so fast you can't capture a trend, so you buy the whole market. So we went back into the four pieces that we use, in our targeted indexes. We went back into total stock market index. Now, we already have a very, very big chunk of VTI, which is the Vanguard Total Stock Market Index, which I love. And so I wanted to diversify away from that. I like to use, the big companies, State Street, which makes Spider, BlackRock, which makes iShares, and Vanguard. Those are the three that I use mostly for our portfolio, just because there's a whole bunch of reasons. But what the question is why is there a difference in rate of return? So iShares has a total stock market index, and Vanguard has a total stock market index. Schwab has a U.S. broad market index. They all have slightly different rates of return. I've been watching them today. It's kind of amazing. One's way up and one's down. It really comes down to the number of different stocks that are in there. So, for example, VTI, the Vanguard Total Stock Market Index, has about 3,900 stocks in it, which is a vast majority of the number of stocks here available in the US. And if you look at, let's say, the Russell 3000, that's only 3,000 stocks. That's a very broad mixture, but that's 900 less stocks. If you look at the iShares Total Return, ITOT, about 3,600 stocks. Still quite broad, but they're all going to be different because of the number of holdings. And Vanguard has the most. So I'll give you an example. So the Schwab US broad market has about 2,500 stocks, Vanguard 3,900 stocks. They both are at 0.03% internal expense. Really, really low. But Schwab is a for-profit company and Vanguard is a nonprofit company. And so what that allows Vanguard to do is to spend more money buying more of those shares and still charge the same amount, where Schwab can't do that. If they want to match them on fee, they've got to buy less shares. And so they have 2,500 instead of 3,900. So doesn't mean one's better than the other. Because it depends. For example, if you've got one that doesn't have as many small cap stocks and small caps do badly, the Vanguard does worse. So I do like the diversification, but that's why they're different. They're not going to be wildly different over a period of time. They're just not, because they own so much of the US market as a whole. They'll generally track extremely close, but there is some differential even on a day by day basis. So yeah, that's a good question. It's very interesting. I watch all of these. There aren't that many of them that I'll really look at, but I watch all of these, on a regular basis, and they're very interesting. And I think it's the way to go right now. I get asked all the time. I was at the bank, the guy's asking me, "Hey, what would you do right now?" And it's the total stock market indexes, just because it's so difficult to find trends this year. That will change eventually as things really do reopen. But I think one of the problems with the trends right now is that there's so many things going. There's labor, there's not labor, there's a virus, it's off, okay, it's gone, now it's back. We're reopening, we're not reopening, we're wearing masks, we're not wearing masks. It's just a hodgepodge of different things happening that are really just driving, the market crazy in different ways. And sometimes it's growth, sometimes it's value. The 10-year treasury is way up, and okay, now it's back down, now it's coming up again. Yeah, and these are the churning that's happening as we go into a more normal scenario, which would be probably sometime next year. And once we get there, there'll probably be some trends that emerge, and we can basically use our targeted indexes for those trends. But right now, we're really looking for very, very broad indexes that cover a very large portion of the capitalization of the U.S.
Yeah, so another question about kind of like, portfolios and stuff like that is so this question deals with I have a large position from my company stocks in my, taxable brokerage account. Um, should I balance my IRA and my brokerage account both to like 60/40, or should I kind of combine them and think of it as one big portfolio?
Yeah, that's a good question. So basically, somebody has $1 million worth of their company stock sitting in a brokerage account or former company stock or something. And then they've got these IRA accounts, they got other accounts. And so one thought would be, well, I want to be 60-40 stock bond split. And, do I just make every account 60-40? The problem with that is quite obvious. If you have $1 million worth of your company stock, you probably have a capital gain on it that's quite high. And so very difficult to like sell 40% of that and buy bond or what have you. And so what I think is the best way to do is to look at the entire household as one unit and then figure out where you can make changes to get yourself to, if 60-40 is the mixture you're really trying to get to, but you build around that holding and you try to make the entire thing work together. And so what that might mean is that you have, a much less exposure, like say 20% in your IRAs, because you can move your IRAs without tax and leaving your corporate stock. Now, there's a whole bunch, we could start a whole nother conversation on how much of that stock you should keep and how you should handle that, whether you should be selling some anyway. That's another thing. But let's just say, for the sake of argument here, that for whatever reason, we're not going to sell any of that right now. And so you want to, if you put all of your other accounts at say 60%, and then you leave this $1 million situation with 100% in this one individual stock, which is actually quite aggressive, no matter what company it is. GE came down 90% from its high at one point in time. So anything is possible if GE can fall apart. And so, we have to be careful with that. Again, that's another story. But I would probably be looking at how can I adjust the other accounts to compensate for that stock. I'd be looking at what that stock was and maybe even trying to adjust some of the targeted indexes so I'm not buying the same things. Let's say it's a tech stock. And so, moving a bunch of more money into tech and the other accounts they have gives me an overexposure there that could be a problem too. So, generally speaking, no, I'd be looking at trying to build around that as much as possible. But there are other strategies that have to be considered, and I'd be negligent not to mention it. But just in the sense of what you should actually be doing with that company stock as well. But in this scenario, we'll just assume we're going to keep it.
So would you ever include real estate into this kind of portfolio? Say like my home or a rental property is kind of, to balance that kind of piece as an investment.
I don't, mainly because I look at things that can be liquidated, within 7 days. And theoretically, a home could be liquidated within 7 days. But the investments that I'm looking at that, are liquid. And so I'd look at, the stuff that's in the banks, the cash, the money markets, whatever. I'd look at all the bond holdings that somebody has. I'd look at all that stock holdings. And I wouldn't potentially add the real estate. In some situations we might, but a whole lot of our clients have told us, hey, this is my house, I'm not moving. So I mean, why would you count that? It's not an asset, it's a place to live. And even though could be worth a lot, obviously it is, it's not an asset that we could count on to offset what might happen with that particular individual stock. So normally no. And like rental properties are an income unless you're going to sell them. And so that income is very important from the financial plan standpoint. And that's a critical aspect. But in terms of trying to balance a portfolio, let's say, I would be, not including that real estate in there in that calculation. I mean, obviously we counted and it has all kinds of ramifications. And if somebody tells us they're going to sell it, that's a different story. We might be counting it then as part of the scenario. And we have done that. We've done some financial plans, even just recently, where somebody was going to move in a few years in retirement, and we modeled that and we have that. And so that money's in, at least in the plan, that money's in their portfolio and we're allocating that. Hasn't happened yet, but when it does happen, we have that. So that's how we would count it. If somebody said, I'm going to sell it, that is legitimate. Otherwise, I don't know. Honestly, people don't sell their real estate very often. You got rentals that are working, people keep them for a really long time. You got a home that you like, people stay, unless they want to move or need to move.
Can you still hear me, Tom?
Yeah, I can.
Oh, yep. So another question. Last week you mentioned the 60/40 portfolio is really efficient. What does that mean? What are you talking about when you say efficient?
Ah, so efficiency has, at least with investing, in my opinion, has to do with what return you're getting for each unit of risk that you're taking. So risk can be analyzed a lot of different ways. There's a whole bunch of different ways, and I won't get too technical here, but for every unit of risk you're taking, what return are you getting? And so a 60/40 portfolio tends to have the most return per unit of risk, if that makes sense. And so they have a thing called the efficient frontier, and it's actually a chart where you've got on one side you've got the return, and then over here you've got this is the risk and this is the return. And so they plot like every possible return for different mixtures of stock and bond. And what you find is, again, on that chart, the portion that is closest to the all highest return for no risk, which doesn't exist, is a 60/40 portfolio. So that's what they're talking about there. Um, there's a whole bunch of debate about this right now and what is 60/40. And boy, when you just say stock versus bond, boy, there's so many different types. you know, what about alternatives? What about, metals and all those types of things? As far as that goes. And it gets, pretty controversial. But in general, that's what they're talking about when they talk about 64. And you'll hear this a lot. And honestly, by chance, our portfolio, our mixture within our practice is 61% stock and the rest, bond and cash. And again, that's because that's not like by design. That's 270 households all choosing the risk level that they want for the return, living with that for decades, making adjustments, and they have ended up at that spot exactly. I'm not like a huge proponent. Everybody has to be in there. We got people in 10% stock, got people in 100% stock, but the average is 61% within the practice. It tells you, and again, these people are living with it. They're watching these things day by day or month by month or year by year, and they're liking what they're seeing. And and again, that combination is around 60/40. So even in the real world, ignoring all of the fancy efficient frontier concepts and what have you, people are gravitating towards an average of a 60/40 portfolio. Even I don't push that per se. I think it's very personal. Each person's risk level is unique to them and their situation, what risks they need to take, what risks they're able to take just mentally. So anyway, I do think it's an interesting area. Lots of articles coming out right now about, 60/40's dead or whatever. I don't know. I don't see it. Not in the real world.
Yeah. And so we got a little bit more of current news. So earlier today, there was some agreement on the 15% global tax. Could you explain what that is and what it could mean for the US?
Oh yeah, this just came out literally just before the show started. I was reading an article on this. It's been talked about for a while now. So the concept is, and this is very different, and I think this is very exciting actually. The concept is that the companies, and they've now said big companies, so small companies will be excluded from this. Companies will have to pay a minimum of 15% tax in the country where the sale was generated. So think about this for a minute. So if you're a big company and you sell to U.S. customers, but you have plants in Ireland, Ireland has a much lower tax bracket than U.S. They, through series of maneuverings, might be able to claim a lot of that revenue in Ireland at this lower tax rate. And of course, then the U.S., who has created this big consumer base, isn't getting the tax dollars for that. And so what that's a huge deal. So think about it. The US is the number one consumer country in the world. And we have this scenario where we've got all kinds of money floating outside the country paying taxes in other tax havens. And now they're going to make it an even 15%. So even Ireland is 15%. And that would be unbelievable because it would bring in, I think, a huge amount of money into the U.S. Treasury in new tax revenues from these companies Um, and it creates a scenario where you're not, Janet Yellen's been talking about a race to the bottom, where, eventually there's a country out there with a 3% rate and everybody's got their business there. And so I think they've got agreements with basically 95% of the gross domestic product of the world in the agreement right now, and it's taken a while to get a couple of these countries to sign on. I don't know what the next step is, honestly, because it just came out, and I don't know the details, and they haven't mentioned any yet either. I think conceptually. They're trying to work on this from a high level standpoint, and then we'll get some more of the details that come out for how that works. But you have an awful lot of big companies here in the U.S. and abroad selling a lot of products to U.S. consumers that are not paying taxes at a proper level, in my opinion, here in the U.S. And so that would change with this, in my opinion, from what I've read. So I actually think it's a really exciting arena. We'll have to see how it plays out, but there is one part of it that'll be a little interesting in that it is a possible increase in taxation to some of these companies, and that affects stock price, right? So we'll have to see what that means, right? So if a company was paying 6% and now they're paying 15, that's less revenues. I mean, sorry, less earnings because the higher tax rate. So, and higher tax rates aren't awful for the stock market. If you look back over a period of time, they can be short-term, problems until things get worked out. But it is something to consider as far as what impact that might have on the stock market. But overall, from what I've read, I think it's a really great concept. It would solve a lot of problems that have been happening.
Yeah, and to go a little bit more into implementation, I think the implementation is the hardest part because just for the US, any kind of treaty that you ratify, you need, 2/3 of the Senate to agree to it.
Yeah.
And that's not an easy task.
Yeah, that's for sure. They did get 2/3 for the infrastructure package in the end, so there's some hope, right? And this is a a gain to the U.S. economy, or at least the U.S. tax collection. But it's a higher tax, right? So the lobbyists will come in out of the woodwork, pushing on trying to get these guys to vote no on this because the big companies will have to pay more theoretically, depending on their structure, because they won't be able to, move that money offshore. So, or at least the tax money offshore. So anyway, yeah, that there's a long ways to go to get there, but it is exciting, and there's so many countries that have signed on. It will make it a little harder, I think, to not get to the 2/3. In other words, there's going to be some pressure, but from the fact that I think there's 80 different countries signed on to this at this point in time. Um, so we'll see how that plays out. I think these big ones tend to have more chance of getting passed, but you never know.
Yeah. So back to personal finance. Should I be looking to sell my house soon? I'm worried that I'll be penalized if I have a capital gain over $450,000.
Yeah, so I think what that question is alluding to is that the current reconciliation bill as it stands is looking to increase the capital gains rate from 20% to 25%, uh, and above 450,000. And so that would make a difference, correct? I mean, if I sell my house now, before that happens, in theory, if they don't go backwards, sometimes they go backwards, they make it retroactive for 2021, then it wouldn't matter. But let's assume they don't make it retroactive. They have before. But if they don't make it retroactive, then you'd have this choice of, oh, I could sell my house now, before that. So uh, that that's first of all, that's be the first thing I'd wonder about, is are they going to make it retroactive? And it because it's a huge differential. If they make it retroactive, then you can't. If it's at 25 for everybody, including people that sold stuff in February. So that's why I hate retroactive. But the one advantage of having retroactive tax is that everybody can't run out and try to sell their homes all at once or sell property or stocks, which creates some selling pressure and bring the market down. Um, Yeah, I would think if you were going to sell, let's say next January or February, and they told us, in late November that the tax was going to go up, you might try to get that out there and try to sell it before then. But honestly, housing is not that easy to sell. There's a lot of things that have to happen sometimes too. Maybe some people will sell some of their stocks, pay a little bit less capital gains. But a 5% increase, honestly, in my opinion, you got to be careful. I mean, just selling, let's say you have some great stocks that you love and you're going to sell it just to pay 20 instead of 25. You have to wait 31 days to buy that great stock back, or you're going to buy something else. You could make less money pretty easy in that same and lose the 5% that you might. I don't personally like the concept of taxation, making the reason for why you do things, and especially when it's only a 5% differential, which I don't think is enough to really be going out of your way for this. If you're in the right perfect scenario, think about it. But if you weren't planning on selling your house and then you would because of a 5% difference, you know, where are you going to go? Are you going to make as much money on that house as you've been making on your house? You could easily lose the 5% that you might be gaining, by selling early. And the other part of this is we have just funded the government till early December. That just means very, very likely that this reconciliation bill, if it does get passed in time to raise the debt ceiling, is probably going to be early December. But it's just the way it works. I mean, there needs to be a hard deadline for, hey, the government's going to run out of money if you don't figure out how to make this bill in order to get these things together. And so, how much time are we going to have? So, maybe within individual stocks or different things, there are some things that I would definitely do, but I would be looking at that as sort of more minor issues, that you're kind of working around instead of some huge decisions. A 5% is not enough difference, in my opinion, to really get aggressive in that area. You know, it's a it's a fascinating and honestly, we don't know what they're going to do, right? There's been all kinds of talk. Lots of things have changed. Corporate taxes were going to be 28 or actually 35 at one point, is where they were. They were going to move it back to 28, and then 26.5. Now I'm hearing 25. Who knows what it's actually going to be? We're going through the crucible of creating this. It could drop, it could disappear. I don't know. Although, there seems to be some cohesiveness around a 25% capital gains rate. So we'll see.
Yeah, because originally they were shooting for a 39.6% capital gains rate.
That's
We're
right.
same as the top bracket. Now it's maybe at that point that could be a high enough, capital
Yeah.
gain that you could start thinking about, the house sale. But the five
Yeah.
percent gain is kind of iffy at that point.
Yeah, exactly right. Going to go from 20 to 39.6. Oh, okay. That's different. I might do something more aggressive because that's huge. That's a big differential. Going from 20 to 25. Yeah, exactly right. Just maybe not as much of a push and, for all the things that are going on out there. So, yeah, really interesting. So, okay. So thank you everybody for coming. Really appreciate great questions altogether. Again, you can send those questions in anytime as they come up. Let us know, and we'll put them in on the show, and you can watch your question come up. And look forward to being able to see you next week. And again, you can subscribe with the button. You can send us your email if you want us to send you, our content as it comes out. Or if you want to set up an appointment, you can go to, the website that's there on the YouTube page you're looking at now, and hit the book appointment button and schedule a 30-minute, phone or video appointment, and we can talk to you about your specific situation. So I want to thank everybody so much again for coming today, and I look forward to